Capital ratios, ICAAP, stress tests, buffers, AT1 instruments. We hear these terms all the time in banking. But what do they really mean in practice? Capital management sits right at the intersection of regulation, strategy, and profitability, and it's one of the most important disciplines in modern banking. Now think of a bank's capital as its safety cushion, its shock absorber. In the simplest terms, capital is the money invested by shareholders, the equity that remains once you subtract liabilities from assets. It's the buffer that absorbs losses while the bank is still operating. Now to make that more tangible, imagine you own a house worth £300,000 with a £250,000 mortgage. Your equity is £50,000. And if the house price falls, that £50,000 takes the hit before the lender does. Bank capital works in exactly the same way. It's the first line of defense if loans or investments lose value, protecting depositors and creditors. Now that is why adequate capital is essential. It keeps banks safe, sound, and able to withstand shocks without collapsing. But capital management is not just about having a cushion, it's about managing that cushion. It's about planning it, monitoring it, and optimizing it so the bank can meet regulatory rules, support business growth, and stay within its risk appetite. Now, capital is what stands between a bank and insolvency. Banks rely heavily on deposits and debt, which creates leverage that boosts profitability. But that same leverage means even relatively small losses can wipe out equity quickly. Now, capital absorbs those losses, underpins confidence, and allows banks to keep lending in downturns. And history has shown us the importance of this. During the 2008-2009 crisis, many banks simply didn't have enough high-quality capital. Confidence evaporated, failures cascaded, and regulators introduced reforms like Basel III to force banks to hold stronger capital bases. Today, regulators worldwide insist on robust capital because without it, financial stability disappears. Now, not all capital is created equal. Regulators divide it into layers. The first and strongest layer is Common Equity Tier 1, or CET1 for short. Now this is the gold standard of capital, made up of ordinary shares, retained earnings, and simple reserves. Losses hit CET1 immediately, making it the thickest, strongest bumper on the balance sheet. The next layer is Additional Tier 1, or AT1 for short. Now this is usually hybrid capital such as contingent convertible bonds or preference shares, which can convert into equity or be written down in stress. They pay high coupons, but investors know they'll absorb losses if ratios fall too far. And finally, there is Tier 2 capital, which consists of subordinated debt and reserves that only absorb losses once the bank is in resolution. Now this is often called gone concern capital because it comes into play if the bank fails outright. Now, together with CET1, AT1, and Tier 2, they form the regulatory capital stack. Now, under Basel III, banks must hold at least 4.5% of RWAs as CET1, 6% as Tier 1, and 8% as total capital. Now, on top of this, they must hold buffers. Now, the key ratios here are the CET1 ratio, which is CET1 capital divided by risk-weighted assets, the total capital ratio, which includes all tiers of capital divided by RWAs, and the leverage ratio, which measures Tier 1 capital against total exposures without risk weights. For example, a £1 million mortgage might carry a 35% risk weight. That means $350,000 in RWAs. With an 8% minimum capital requirement, the bank must hold £28,000 of capital. For a riskier loan with a 100% weight, the capital needs to jump to $80,000. So risk weights encourage safer lending, but they can understate risks, which is why regulators also impose the leverage ratio as a backstop. So banks must always meet whichever ratio is stricter. If they fall below these thresholds, they face automatic restrictions on paying dividends, bonuses, or coupons. Now, to stay ahead, banks carry out detailed capital planning. They project their balance sheets years into the future, assessing how growth, earnings, and distributions will affect capital ratios. They also run stress tests. Now, these simulate extreme scenarios, so a severe recession, a market crash, or a wave of defaults, to see how much capital would be consumed and whether requirements would still be met. In the UK, the Bank of England runs annual system-wide stress tests, and in the EU, the European Banking Authority coordinates EU-wide exercises. Now, banks also run their own internal stress scenarios, and the results feed into the Internal Capital Adequacy Assessment process, or ICAAP for short, where banks set out all their risks, capital needs, and buffers. Now, supervisors then review this through the Supervisory Review and Evaluation process, or SREP for short, and can impose Pillar 2 add-ons if they are not satisfied. Now, the clear message is that banks must plan for the worst, not just the baseline. Now, because capital is scarce, banks must deploy it wisely. They allocate it across divisions like retail, corporate, and investment banking, and they measure returns relative to the capital consumed. If a business line uses a lot of capital but earns little profit, management may shrink it, reprice its products, or exit altogether. Now, this is where concepts like risk-adjusted return on capital come into play. The goal is always to use every pound of capital where it generates the best risk-adjusted return without breaching appetite or regulatory rules. Now, investors watch this closely too. Too much unused capital drags down return on equity, while too little capital invites regulatory intervention. The art lies in striking the right balance. Regulators also require banks to hold buffers on top of the minimum ratios. These include the capital conservation buffer, usually 2.5% of CET1, the countercyclical buffer, which rises in good times and is released in downturns, and additional systemic buffers for the largest banks. If a bank dips into these buffers, automatic restrictions apply on dividends and distributions. Now, we saw this during the COVID-19 pandemic in 2020, when regulators required banks to suspend dividends and buybacks to conserve capital. Now, in normal times, boards weigh shareholder returns against the need to stay well above requirements. And most banks hold comfortable management buffers so they never risk falling into automatic restrictions. Now, even with careful planning, surprises can happen, so banks prepare contingency plans to restore capital if needed. Now, these recovery plans include cutting dividends to conserve earnings, issuing new equity through rights issues or offerings, issuing AT1 or Tier 2 instruments to tap debt markets, reducing risk-weighted assets by selling assets or scrutinizing loans, and sometimes even pursuing strategic mergers or external injections. Now, timing is everything. Raising capital in calm markets is far easier than in a crisis. Well-prepared banks issue proactively, while weaker ones are often forced into distressed fundraising. Ultimately, capital management is about balancing competing demands. Boards set the bank's risk appetite. How much capital cushion is enough? Shareholders demand returns. Higher return on equity means using capital efficiently. And regulators demand resilience. Higher capital means safer banks. The best banks treat capital as a strategic advantage. They are strong enough to inspire confidence, but flexible enough to grow and compete. Too much capital weighs on profitability. Too little capital threatens solvency. The skill lies in finding the sweet spot. Now, to summarize, capital is the shock absorber of banking. It comes in layers: CET1, AT1, and Tier 2. It's measured through ratios, buffers, and stress tests. It's managed through ICAAP, capital planning, and contingency strategies. And it's consistently optimized across business lines to balance stability with profitability. In short, capital management is survival management. It's the discipline that keeps banks stable, trusted, and able to support the wider economy through both good times and bad. So here's something to think about. If your bank had a really bad year, losses, defaults, or a downturn, would it still be able to stand on its own 2 feet? Let us know in the comments below. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out the industryportal.com link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.